Welcome back to the channel. Today we're going to go over the S&P 500 and the Nasdaq 100, especially going into the beginning of this year. I want to do a little bit of a broad viewpoint over the next few weeks of things to be anticipating when it comes to the market. We're going to talk about what's kind of been the catalyst that's kept us going over these past few weeks. You know, we looked at the past 4-5 weeks. It's been just fantastic. Now, granted, we have a little bit of chop here, but ultimately, since middle of November, it's been beautiful. And I think there's a few things that this comes down to, and that has really drove the market. So again, you look at the Nasdaq, it's been the leader all year. One is something like ES, and again, very strong also. You know, we look at the past 9 weeks, it's been like incredible, right? But in my opinion, there's things that this comes down to, right? It comes down, in my opinion, what's happening with the dollar, straight inverse of what's happening here on this chart. And we also go into the US 30-year yield and how this is playing an impact to the market. We can see what's happening there. But again, I think there's key things that we're looking at and why this could continue, especially into Q1 for 2024. And that's what we're going to be attacking today. Now, before we go into any of that, I ask you to do two things. Consider liking and subscribing. It helps out tons. I appreciate all the support. The Discord spots are available now today. It's first come, first serve. So they might close up tomorrow. They might close up, Wednesday. I don't know, right? So when those spots fill up, they will fill up and it'll be done. So make sure you're taking advantage of that if you are interested. Now, let's jump back into this. So a few things I do want to talk about, right? I also the newsletter was out today, so make sure you check that out. It was at 10 a.m. Central. So what's happening here? And the first thing I want to do is I want to jump into this because I think it's important that I'm a visual guy. Sometimes I need to see exactly what you're telling me, what you're describing to me, exactly how to work something out, okay? And so when we look at, this is Freddie Mac, this is probably the easiest way I can do this for you guys. There's a little bit more complex sites, but this is the one I chose to look at today. And so what you're going to identify here, and I wish I could lay this over with what's happening with the market. Okay, but we basically had our peak on our weekly rate. So what's happening with the average United States mortgage was up 7.8%. I thought it was 7.8%, okay, on the 30-year mortgages. You go back, you can see that obviously mortgages lag what's happening with the yields and then also what's happening with interest rates from the Fed. That's number one. So meaning when those start to drop, when yields and the Fed cuts rates, it takes time before it can affect what's happening with, the market, right? Just like with oil. Oil takes a little bit longer, like a month, but that's a lot of supply chain. These are directly affecting what's happening with prices. So within a week, 2 weeks, it usually gets affected. Okay. So we saw the peak here on the 30-year. You saw the peak here on what happened, obviously, with the mortgages as well. Now, we also go back and we look at something like Nasdaq. And I think this is important that we're identifying how this plays a part with the market. The same thing happened, right? The 23rd of October, that marked your bottom on the Nasdaq, on the S&P, right? Go to ES, right here, October 23rd, right? Mark the bottom, right? For those of you that are SPY guys, right? SPY, October 23rd, hit a support, held. QQQ, hit the support, held. IWM, the list goes on, everything, right? They're all playing into this, okay? And so I just want this to be known that these, what's happening with interest rates has been the driving force of weakness over the past 2 years, basically, in the market. Anytime we've seen a downward decline, any type of selling, it's been led by what's going to happen from interest rates and slowing down the economy, okay? Those are the biggest things there. Now, I know some people are going to be like, look, the market hasn't slowed at all. It's this, it's that. Well, it has. Now, maybe the Magnificent Seven or the biggest companies in the world haven't slowed down as much, okay? But if we take, the top, 3% of names and then the 97%, we'll still see that a lot of those names are nowhere near all-time highs, right? If I go down any mid-cap, small-cap list, they still have a long ways to go. The only names that are really at highs or all-time highs are either semiconductor names, cloud names, or the Magnificent Seven. Everything else is kind of in between. Now, there's a few outliers there, so you're going to be like, well, what about, X stock? What about, Caterpillar, right? I'm like, okay, well, Caterpillar made it, right? Okay, so there's some stocks that are going to be like out of the equation that'll be abnormal, right? But for the bulk of stocks that aren't related to cloud, semiconductors, or the Magnificent Seven, they're not there, which is a lot of companies. There are a lot of companies, okay? And people are like, what about McDonald's? I'm like, okay, McDonald's too, you got me, right? Those are safe stocks. So I just want you all to identify that. And so when you're looking at trading this, you have to come into it with that mentality. Now, I think we have to do one step further now. And this is something big that I've been trying to cover on the channel for a while now, is, well, what happens at this point, right? What happens when you get to here? because, this is the level we've been talking about for a minute, and this is the 4% level on, yields, right? The 30-year yield bonds, right? Very important. Okay. Now, I also want to take you to TLT. So, and again, I've had questions about this. Maybe I just want to clarify. When bonds go down, or when yields go down, bonds in theory go up. Okay, so TLT. So TLT should be moving inverses, which it is, right? October 23rd, that week, down your bottom, great recovery, right? Your average resistance, major level. You can see over the past year, this was your support. December 2022, all of 2023, this was your support. Once this broke, the market got bad, got ugly, okay? That's important to realize. So now we're going to go back over here to the yield, 30-year. And again, if I'm losing you, please comment down below. I'd love to answer your questions and hopefully give a little bit of breakthrough here. I think it's very clear that this level is your line in the sand. I don't think it could be more clear. I really don't think it could. Okay, so there's a few things that have happened over the past few weeks and months. Now, when we go back here to like July, we did, I think, one more rate hike, and then we kind of stopped, right? But since then, we basically paused on rates, and then the yields continue to go up, and that's what really drove the market to the downside and all that decline. And then now we're almost at this area of we're done raising rates. There's no reason yet unless inflation comes back into play, right? And so that's where we're sitting at. As far as data is concerned, that's what we have to also realize. It's not about how we feel. It's about data that's coming on the market, okay? So going into this, with this year, this is the level you have to watch, okay? And especially if you're a shorter term trader right now, all you should be paying attention to is, do you get the break on I would be looking at the daily time frame, to be honest. Can you hold belows on a daily time frame, retest, and push back down? If I go back and I look at what happened, back here, I go to the daily time frame. We're going to go back here, November 7th through the 14th of 2022. Okay, we're just going to zoom back here. This was kind of fantastic. You got this. Actually, I need to go to the 4-hour time frame, actually, so I can see more data here, right? And so you kind of get down to 4-hour. Get the break, retest, immediate, and there's just turmoil for the next, essentially, month of just downside. And then you bounce, and then you come back down. And it's over and over. This trend plays out and plays out and plays out. But you can never get back above 4% with such a big line in the sand. A lot of bond traders, a lot of yield traders, that were going short on, bonds and yields. This was their line in the sand. This was their take profit. It was a major level. So it's not a coincidence to me that we're finding support here. We're finding resistance, whatever you want to consider it, whichever way you're trading it. So now the question is does this break and hold? And I personally believe it does for a few reasons. Okay. Now let's look at the broad viewpoint. If, I like to play devil's advocate on both sides. So I'm going to start with the crazy part. Okay. So for some of you guys, I know some of you guys are a little bit conspiracy theorists, and I find myself dabbling in that idea sometimes as well. If you look at the market from a viewpoint of it's all rigged. Okay. Let's say it's rigged no matter what. Okay. Right. I try never to trade based on this idea, because I'm trading based on emotions and feelings and everything that I know I shouldn't, right? But we'll play the game. If it's rigged, it's an election year. I would argue, and again, I'm don't care, Republican, Democrat, I don't care. I just want to make money in the market. Don't care. So if we're looking at it from that viewpoint, the market's rigged, okay? If we look at the presidency and what's happening right now, I think we could all agree it's been a lackluster presidency. Nothing but bad stuff has happened. Maybe he comes out and says, you actually can't. Biden really can't come out and say at the election, but the market's at all-time highs. It helped us recover. Well, you have families, middle-class America in turmoil, getting smacked around. Pretty tough. But he also can't let the economy come back down. He has to do everything in his power to help it continue to go up. Okay. So if we look at yields and what's happening here, what is Biden's idea? And you might have seen this in the news. Biden has kind of tried to attempt to go all in here. He's tried to, push for new homeowners, right? New incentivized plans for getting, tweaked rates, lowering those rates. But what can help those even more to where it's not as difficult to do is if you get these 30-year yields to drop. If you can encourage a rate cut over the next few months. And if the idea of a rate cut gets put into the market, what do we know? The market's forward looking. It doesn't wait till something comes out to start moving, right? Once the idea that we're done raising rates, look what happened. The idea got put out there that we were done raising rates from the Fed, and you dropped, right? Quick. with the yields, right? The yields are much more important when it comes to movement because you're not having, there's no retail effect, there's no squeeze effect, there's no gamma, this or that, right? It's pretty blunt with how the movement there is there. Okay, so you're at that viewpoint. If you think that way, I think that all the incentive for yields and the market to do well is benefiting the corrupt. In my opinion, if I was thinking that way, it would only benefit the corrupt. Okay, and then if you're corrupt, you're like, well, hypothetically, if Trump gets elected, right, and they would want the market to crash with him, so you'd want to put it in the deepest hole you could. Okay, now again, I'm not huge when it gets to like election time, like September, October. I might be MIA. I might not trade for a whole month, 2 months. To be honest, I'm not gonna lie to you. I might just take some time off for myself. But those are things to think about. Now we think about it from the other side of the view, just data in general. So we know since basically September, October, data's been great. It's been fantastic, right? I mean, you can't lie. You look at these, you look at what's happening here. Home sales have slowed. They have slowed into the end of the year. Makes logical sense. Holiday season, right? But now we're coming into the beginning of the year. And what happens at the beginning of the year? You get your income taxes, you get a little bit of a surge of money. You just had your Christmas bonuses. A lot of your expenses have been accounted for already, right? So now you're at that point of where you are encouraged to buy homes on top of what's already happening with Biden and them trying to push this as well. Okay. And then you're looking at it from the viewpoint of, okay, I haven't even had an opportunity to buy since the beginning of 2023 when we're at 5% on 6% on 30-year mortgages, right? Haven't you had an opportunity? We just dropped from almost 8% on 30-year mortgages down to 6.6 in a matter of a month and a half. Maybe you're talking to your real estate agent, right? And what do salesmen do? They sell. They push it down your throat. And I'm just saying, maybe you say, well, I'm not going to get convinced of that. I mean, have you looked at the reality of the situation of America and what's been the foundation of our principles over the past 4 to 5 years? It is spend, spend, spend. Savings is not prioritized. It is what it is. And if I am looking at the market, if I'm looking at what's happening with spending, if I'm looking at what's happening there, again, I get pushed to the idea that more than likely we don't make the decision of maybe we wait, maybe we be patient. I think maybe it's an acting time for most people, especially if yields continue to drop. If you lose 4%, I am telling you, this looks like a very hot market for real estate over the next few months. Extremely hot. And then if data supports that thesis, right, and then we somehow get a rate cut or something along it's going to be a domino effect. It's going to be a very quick domino effect. And so when we look at yields, I think yields and mortgage rates, it's your catalyst. It's as simple as that. Okay. Now, beyond that, that's both sides there. We look back at oil. And I think a lot of people have questions about oil and oil getting bullish in this. I'm like, what are we talking about? What are we talking about? So we look at 2022. Let's just take a quick gander here. Okay. So from the beginning of 2022, where was crude, or 2023? Let's look at 2023, the beginning of the year. Dude, I can't believe it's 2024. We're about to start, right? It's kind of crazy, right? So the beginning of 2024. Right, 2023, right here, right? Oil was on the decline, had been dropping. Now, what do we know about oil? Oil was one of the biggest catalysts with energy that impacted inflation. One of the major catalysts from what happened in Ukraine. It was a perfect storm. It was just down all year long. You get until almost July, and it's still in the downturn. And then once oil spikes, the dollar spikes, and that's what gets a little bit of a resurgence of inflation. Well, since then, since we found our bottom around, oil takes, we all know it takes about a month before it starts to hit inflation numbers, right? So if we do the math, September 23rd, September 28th, September 27th, when you reach your high here, what happens a month later on October 23rd? Funny enough, this just shows you how this all lines up. You see yield spike at highs. You see the dollar spike at highs. Again, it all starts to play out. You start to see what's happening here. And so with oil, I think it just supports the catalyst more. If oil continues to dip, and oil most likely will find a bottom. But we've seen overall global oil demand drop, not just in the United States, right? So people say, well, when oil demand drops and energy demand drops, the market typically gets annihilated. And I could agree with that thesis. But let's look at what's happening in Europe. They've been in a true recession for almost 2 years now, a real true recession. They are on the borderline of starting rate cuts. We look at Japan. What are they doing? Japan is they are welcoming inflation. They're saying we're going to keep our interest rates at negative 0.1, right? So we look globally. The only economy that's really looking like I don't know if there's hope is China, which could America not? America. Let's be real. Like, we would love for China to not thrive while we start to thrive again, right? Which we already kind of are thriving. So again, you look at this broad viewpoint. Oil demand dropping is beneficial towards U.S. inflation. It is beneficial no matter what, however we put it. If this can hold up until summer, it gets back on your toes and helps you in the next year's time frame. Now, I want to make sure that I don't put my foot in my mouth here. This could be very bad for the market over the next 2-3 years. It could be terrible for the market. If you see half of America gets trapped into rates at 5% or 5.5%, 6%, whatever it may be, and inflation does resurge, then yes, it's going to be a domino effect on foreclosures, right? I don't think banks collapse or anything like that, but it could cause issues down the road. But the counter argument to that is the housing shortage that's here in America. If you look at what's being built with multifamilies all around the country right now, it sides with the thesis that as long as rents are this high, and rents won't drop based on how much it costs to have a house, based on your mortgage, they all thrive on top of each other. You can't just say, well, no one can afford that. Someone somewhere can afford that rental property. They just can. We've been having this argument for over a year now that people can't afford rents. Well, spoiler alert, Jimmy, Timmy, whoever you are, they can, they pay, and again, it's supported and helped the housing market stay where it's at. And that's why the housing market has not collapsed whatsoever, right? It's just a fact of the matter. So these are things that we're looking at. These are things that I'm watching. And hopefully this gives you an insight on a bigger picture of beyond looking at, the Nasdaq, beyond looking at the S&P 500, beyond looking at, my favorite stocks. This is what I'm looking at with the overall market. And this is what's giving me direction and insight to some of these moves. So when I look at the Nasdaq, I go to the Nasdaq chart and I look here at the daily time frame and I'm like, okay, I see some downside. But when I zoom out, I look at the bigger picture here. I'm like, guys, what are we talking about? What are we talking? I go to the IWM, I look at the Russell, arguably the riskiest assets out there, small mid caps. What are we talking about? You just broke out of your 2022 level here in August. I mean, that's, you broke out of it, like in all seriousness. And now you're just I see people concerned and I'm like, what are we concerned about? You broke, you're retesting, and now you have to wait for a decision to see if you're going to bounce. But if you bounce here, I think we're more bullish than ever. Are we not? The Dow, we talk about the Magnificent Seven and big tech, but what about Dow? Who's carrying here? As David, who's carrying the boats, right? All jokes aside, everyone's like, oh, energy is killing us. But what about those banks that remember that banking collapse that we had this year? Everyone's like, oh, banks are going under. Everyone's gonna lose their house. Everyone pushed that narrative out there, but banks are breaking. We're breaking out. We're highs in the year. XLF. What about JP Morgan? About to, trying to break all-time highs. Bank of America, breaking out, breaking the clear downtrend. Arguably could be one of the best setups out there. Wells Fargo, and again, people are gonna say these are corrupt or whatever it may. These are just the facts. Mounting previous highs here, 2023 highs. You're mounting them. Again, it's a going theme, and we can't just look at one sector and say, okay, it's just tech. It's not. Look at the recovery we've had since the middle of the year from arguably one of the biggest concerns and the things that blew up in everyone's face, and everyone's like, oh my God, we're going to collapse, the recession. And, we bounced back. The big banks were never going to collapse. They weren't. They're not going to make the same mistake twice in 15, 20-year time span. It's not going to happen. That's my viewpoint. That's how I'm looking at the market. If you have questions, comment down below. Also, too, on Twitter for you guys, I'm doing a lot of charts today, so make sure if you're on there, you can see all the stock charts I'm looking at. So I didn't want to cover too much in today's video, give a broader look, what I'm looking at for charts, stocks I'm liking. But anyways, all there on Twitter. Have a good one, traders. I'll see you on Tuesday. Enjoy your New Year's. Happy New Year as well. Keep killing it. But the one thing I'll encourage for the new year is to grind, guys. Put in the work, put in the hours, put in the effort, right? I promise, I'll tell you from my own experience, the biggest thing that was standing in front of myself was myself, right? It was putting in the hours, putting in the effort, putting in the work. Once I started doing that, once I started surrounding myself with people that were like-minded or eliminating people, there was a time period in my life, I think back to 2020, 2019, where I just eliminated everyone from my life. It sounds depressing, sounds terrible. Not motivation whatsoever, just the reality of my situation. I had a 2-year-old, right? Yeah, 2. He was 2 at the time, right? Going to college full time, making videos, making content, learning about stocks, working full time, then working part time on the side, doing DoorDash, Instacart on the side, right? It was getting alone and realizing that you are in control of everything for yourself, not feeling sorry for yourself when I wanted to feel sorry. I encourage you guys, look at it from that perspective and start taking responsibility and taking control. That's the biggest thing I will say. And I promise you guys take control, you take responsibility, and you put in the work, at least on this channel. If you show up here on this channel, there are live streams and everything like that, you don't have to pay for anything, guys. We have tons of free content where we want to help, we want to work with you guys. And, we want people in our Discord, but at the end of the day, we try to have everything available to you guys for free as well. So if you can't afford it, you can put in the work on your own. You go to our website. We don't sell a course. You go to education. There's not one paid course in here. Not one on our website. This is all free. We go to Twitter. Is this paid for? You cannot subscribe and pay me on Twitter, right? I've thought about it, but I don't want that, right? Now, if you want to talk to us all day, every day, then yeah, Discord's probably going to be where you go. The newsletter, right? All these things. I try to put those in place for you. That was the biggest goal for 2023. So if you guys want that, that's all free. That's not a sales. That's nothing like that. The YouTube videos on the second channel, everything like that. It's all free for you guys. So again, take responsibility, put in the work. 2024, if you are willing to put in the work, I promise you it's yours for the taking.